Question 1. Calculate the total change in value of the portfolio if interest rates shift as projected. Show your calculations. So this is the likely the formula that we're going to be using, because it looks like we're peeking ahead here. We're giving convexity and duration. So this is that formula that we're going to be using. So we need to figure out what the change in value of the portfolio will be if interest rates shift as projected. So we need to, it looks like we're given the duration and convexity. So we need, and yield, or change in yield, sorry. We need to figure out what the change in yield is based on the reading, and then we can kind of just plug that in for the portfolio. All right, so Georges Garnier is a Paris-based fixed income portfolio manager focusing on active bond management. He's analyzing the impact of a 25 basis point interest rate increase on a global fixed income portfolio. The portfolio includes bonds issued by Saudi Arabia and the UAE with the following characteristics. All right, so we've got two issuers, Saudi and UAE, and then we've got all their different stats here. So what we're going to have to do here is we need to show our calculations, and we're going to have to calculate the change for the Saudi bonds and for the UAE bonds, and then we can kind of use that, add those together since this is our full portfolio. So I've got all of this down here. So we're going to take this formula, and then we'll grab the Saudi bond information first. So we've got 4.81 as the duration. Multiply that by the 25 basis point change in yield right here. And then we're going to take that convexity number, which is right here, 18.5, plug that in as well. And then we multiply that by that change in yield squared, which that's 25 basis point change again. So we get a percentage change of minus 1.204. So then we are going to have to take that that change, multiply that by our original price, which is 104.5, and I believe that's given right here. Yep. So we're given that as well, and then we get a change there of 1.26. So then for the UAE bonds, we're going to do all that same math again, and I'll skip over this. You can work it out. And then we get minus 1.04 at the end of that, plugging in all those numbers. So then our total change is just going to be these two values added up together, which gives us total change of minus 2.3. Question 2, identify the most appropriate portfolio adjustment Garnier could make based on the portfolio's current allocation and the market outlook. Justify your selection with 2 reasons. So we've got option 1, option 2, or option 3. Option 1, increase allocation to long-term bonds to lock in higher yields. Option 2, reduce long-term bond holdings and shift to short and medium-term bonds. Or C, increase exposure to high coupon bonds. All right, so let's read our current, basically to what we've read so far, basically all the information we have is that rates are going to increase by 25 basis points. Let's start reading a little bit and see if there's anything else we can or should do here, or any other information we need. During a conversation with a colleague, Garnier discusses active bond management and the importance of duration and convexity in portfolio construction. 2 statements from the discussion are as follows. Duration is a first order effect. Okay, I don't think this is helpful. So I think basically we need to decide what to do given that we're going to have a 25 basis point increase on the fixed income portfolio. So when we are going to see an increase in rates, we generally want to reduce our sensitivity to interest rates, because if our sensitivity to interest rates is higher, then we are going to see a greater price decrease from that increase in rates, essentially. So what we're going to want to do is we're going to choose option 2. So option 2, reducing long-term bond holdings. So reducing long-term bond holdings is going to reduce the duration of the portfolio. Again, duration is an interest rate sensitivity measure. So if you have a duration of 10 you get a 25 basis point increase, that's going to have a much more drastic effect than if your duration is 1. So that's going to lead to lower price decreases if rates rise. And then increasing short-term bonds will lower convexity, leading to lower price decrease if rates rise as well. So the key here is kind of decreasing that interest rate sensitivity. And I didn't include these on here, but ruling out option 1 and 3. So option 1, increasing allocation to long-term bonds to lock in higher yields. This is going to be increasing to long-term bonds. That's going to increase our duration, which is kind of the opposite of what we talked about wanting to do here. And then increasing exposure to high coupon bonds. So having higher coupon bonds will lower your duration, but not to the same magnitude as reducing long-term bond holdings. So we can kind of rule out 1 and 3 with that. And we'd get 1 point for identifying and then 2 points for each, or 1 point each for our justifications. Question 3, determine whether each of Garnier's statements is correct. Justify your answer in each case. All right, so we started reading these in the last question, but let's read them. Duration is a first-order effect and provides a comprehensive measure of a bond's price sensitivity to large changes in yield and maturity. So red flag right here, it's better for smaller changes in yield and maturity. As we get to larger changes, that's where convexity is going to be more helpful. So we could go ahead right away and say this is going to be an incorrect statement for that reason. Duration is more suitable for smaller changes in yield. And then convexity management is typically less relevant for traditional fixed income portfolios. It's pretty relevant, so I think you could probably also say that for that reason it's not correct. Then 2, all else equal, bonds with higher cash flow dispersion tend to have lower convexity than those with concentrated cash flows, which is why high convexity bonds often trade at a yield premium to low convexity bonds of similar duration. So this one's also going to be incorrect, and for that the reason is this part right here. High convexity bonds often trade at a yield premium to low convexity bonds. They're actually going to trade at a yield discount. If we have higher convexity, that's going to provide us better protection essentially to those changes in rates. And so if a bond has higher convexity, we have more protection there. So we can expect to receive a lower yield since there's technically less risk. So we basically said all this already, but statement 1 incorrect and statement 2 correct for kind of those reasons that we already discussed. Question 4, determine which bond position would be most profitable for Garnier's portfolio and justify your answer. So we've got position A, B, and C. We haven't gotten to these positions yet, so let's keep reading. Garnier is evaluating the potential inclusion of the following positions in his portfolio. Here we go. Position A short position in callable bonds. Position B, a long position in putable bonds. Or C, a short position in option-free bonds. Given the projected 25 basis point interest rate increase, Garnier wants to determine which type of bond position would be most profitable under this scenario. So we've talked about this a bit already, but 25 basis point increase, that's going to lead to price decreases in our bonds. So we want, for a price decrease, we want to be short to make money. So if we're short, then we'll make money when our bonds go down in price. If we're long, then we're going to lose money when our bonds go down in price. So for that reason, we can kind of cross off B right away. So then looking at A and C, we have a short position in callable bonds or a short position in option-free bonds. So essentially, we want to be short, like we said. And then for the C versus A part, C is a better position than A since the embedded option will limit price movement when yields change because that option does have value. And then we said B is a long position, will lose money if yields rise. Therefore, position C would be most profitable for 25 basis point rise in rates.